10 things you need to know to live a tax advantage retirement. Hey, everybody, welcome back to the Money Mastery Unleashed podcast. This is Adam Olson, your host, with you today. And on today's podcast, I'm going to give you tools to help you take advantage of lowering your taxes in retirement so you have more money to spend and you give less money to the government. You see, I've been a financial planner for over 13 years, and there's a lot more than 10 strategies that we use for clients. But in this episode, I'm going to highlight the 10 most common ones that were just highlighted in a Northwestern Mutual survey done here in 2024. You see, this survey found that only 3 in 10 Americans have a plan to minimize the taxes that they pay on their retirement savings. That's a huge issue in my opinion. And so today I'm going to highlight these top 10 things that you need to know to be living a tax advantage retirement. Let's start with number 1 right now. The first thing is to make withdrawals strategically from traditional and Roth accounts to maintain a lower tax bracket in retirement. Only 32% of people knew about this. So this is going to be applicable to a lot of you watching this video. So in retirement planning, we try not to just drain one bucket before another bucket. What do I mean by this? I mean that in retirement, you oftentimes are going to have different types of accounts. A pre-tax account that you have to pay tax on everything, a taxable account where it's a brokerage account and dividends are taxed at a lower rate, and you're going to have some gains due every year on any gains that you have that you realize. And then we have the tax-free account, a Roth IRA, for example. So in retirement planning, we like to be strategic with where we're pulling money from and how we're pulling it in order to keep those tax brackets as low as possible. You see, a common strategy that you can implement here with your advisor is to fill up your tax bracket. So if you're in the 12% tax bracket, try to fill that up with as much pre-tax or dividend income or ordinary gains income as you can, and then maybe distribute from some Roth accounts so you don't get bumped up into a higher tax bracket. And a lot of times people have one large time expenses that they have in retirement. Say they want to take a family on a major trip or they have a major purchase. Well, that's a good time to pull from the tax-free account, or maybe you can pull some basis from the taxable account. See, however you plan your year-to-year spending, you need to be aware of where you're pulling the money from, how you're pulling it out, and pay attention that you don't get bumped up into a higher tax bracket. Number 2, you need to use a mix of traditional and Roth retirement accounts. 30% of the people were going to implement this strategy. This goes back to number 1, just to emphasize it again here. Remember, RMDs, required minimum distributions, have to start at age 73. Now, RMDs are when you have to take out of your pre-tax retirement accounts. And remember, these RMDs are taxable. So don't wait if it's not part of your strategy to wait till 73 to turn on these RMDs. Don't wait to take them. A lot of times you can start distributions from these taxable accounts at an earlier age to hopefully level out that tax bracket. Again, make sure to blend your distributions strategically to get you in a lower overall tax bracket over the course of the years. Number 3, make strategic charitable donations. What do we mean by this? Well, instead of just simply giving maybe $15,000 or $25,000 to a charity every year, because the standard deduction right now is $29,200 for a married filing jointly couple. So instead of giving the $15,000 or $25,000, what if you gave $50,000 in 1 year? Then that would enable you to lower your income by $50,000. You don't have to take the standard deduction. You could take it the following year. So don't forget about charity stacking. Maybe that's something that you need to implement in your plan. Also on this one as well, you can gift appreciated stock. So say you worked at an employer or you bought a lot of stock over the years and you have a lot of gains inside of that stock. Well, if you're charitably inclined and you want to give to organizations, you can gift them your stock and they can sell it with no taxes due on it. So you're able to give and then they can get the money income tax free. It's an excellent tool. Number 4 here. This is an extremely important one. HSA accounts. Utilizing an HSA account, only 23% of the people were planning to implement this strategy. Remember, HSAs are triple tax benefit. What I mean by this is that money goes into HSAs, income tax deductible, money grows inside of HSAs, income tax free, and as long as you take it out for the right reason, the right things, qualified expenses, distributions from your HSA can be income tax free. Triple tax benefit from HSA plans. And remember, HSAs can be used to pay Medicare Part B, and they can use to be paid your long-term care premiums up to annual exclusions. So if you have an HSA, do not forget to utilize that option. Do not forget to contribute to your HSA. Number 5, 22% of the people were planning to use this tool right here, which is using permanent life insurance and or annuities for the tax benefits that they provide. So let's talk about life insurance real quick here. Life insurance can give you tax-free income from the contract via loans or distributions or withdrawals. So life insurance, if structured properly, you can gain a large cash value inside of these policies, and then you can access that cash value at retirement time as long as you keep the policy in place, income tax-free. And what's kind of cool about annuities is if you put a large lump sum into an annuity, as that annuity grows and you don't take money out, you don't pay taxes as that annuity grows. So think of there's a wrapper on your annuity, and as your money pile keeps getting bigger and bigger inside of the annuity, you don't pay taxes. Only when you distribute it out is when you pay taxes on that annuity contract. Number 6, making Roth conversions before your RMDs start. Again, required minimum distribution starting at 73. If you use Roth conversions before you take your RMDs or before Social Security, only 19% of people are planning to do this. This is a unique strategy that you can implement with your advisor as well. You see, if you're doing a Roth conversion, you're taking money from a pre-tax account and converting it to a Roth account. And in that given year, you're raising your hand and telling the government that you want to pay taxes on this dollars. Now, what this allows you to do is to shift money into the Roth account where you don't have to take it out at age 73. There's no RMDs on the Roth account. And as it grows, there's no taxes on the growth, and you can take it out income tax free. So don't forget, you may want to delay Social Security, and this is a strategy that you can use to level out your tax brackets. You see, we've had several clients that we've had to work with who they have this amount of income every year, say $50,000 worth of income from rentals, Social Security, you name it, and they haven't ever touched their IRAs, their pre-tax IRAs, and we're looking at this RMD at age 73, and it's say $25, $35, maybe $50,000 in an RMD. Well, a strategy that we can use is a Roth conversion strategy. So say from age 66 to age 73, we're taking a set amount of dollars out every year via Roth conversions to hopefully level out those tax brackets over time. So it's a strategy that you can implement to avoid that tax bomb when you have to turn on your RMDs and start taking out money. Now let's move on to number 7, using a qualified charitable distribution from your IRA. What is this? Only 17% of the people were planning to do this, so it must not be a very known concept. Well, this strategy, you can start doing it at age 70 and a half. So at age 70 and a half, you can do a qualified charitable distribution. And what is that? Essentially what this is you take money from your pre-tax IRA, your pre-tax 401k. And at age 70 and a half, you can shift the money to a church, a charity, a nonprofit of your choice. And the 401k or the IRA will get the money to that entity. And you don't pay tax on that distribution. So if you're simply taking this standard deduction that I already talked about of $29,000 a year, but you want to give some money in a tax efficient manner, and you're over age 70 and a half, don't forget to think about qualified charitable distributions. And remember, age 70 and a half, not age 73. That's an important topic to take with you. Number 8, managing your contributions to other tax advantage accounts like HSAs and 529 plans. Now, I already hit pretty hard on HSAs, but let's hit on 529 plans. Only 14% of the people were going to use this strategy. So 529 plans, they grow tax-free, and you can pass it on to grandkids, kids. You can always change the beneficiary on these 529 plans. And as long as they take out the distributions for qualified school expenses, distributions are tax-free. They can use $10,000 on 529 plans, the beneficiaries can, to repay loans. And they now have that Roth conversion capability inside of 529 plans too. So your beneficiaries, if you have a 529 for them, could potentially take leftover $529 and shift inside of a Roth account. There's a lot more to it than I can cover in this video, but check out that strategy if you have a 529. Number 9. Using basis of cash value, permanent life insurance to remain in a lower tax bracket. Now, 13% of the people are going to do this. And I've already hit on this a little bit as well, but just know that if you have cash value life insurance and you keep the contract in place, you can access the money in the contract income tax free. Now, this would be a great strategy to access the income tax free if you're doing, say, Roth conversions in a given year, because the money from the life insurance, guess what? It's not taxable, and you can use that money to live on while you're doing these Roth conversion strategies to lower your overall income. Now, the last one is an important one that I want you to think about and hear me when I tell you about this. It's called a QLAC contract, Qualified Longevity Annuity Contract. Now, these contracts are set aside by insurance companies, and you can put up to $200,000 of pre-tax money into a QLAC contract. Now, why would you do this? Well, remember earlier when I said that some people have a tax bomb in their RMDs that's a significant amount of money and it's going to bop them into a higher tax bracket? Well, if you shift $200,000 from your pre-tax retirement accounts into a qualified longevity annuity contract, that money is essentially sheltered from the RMD calculation that you have to do starting at age 73. In addition to that, QLAC contracts can provide you with lifetime income at a specific date. So let's have an example here. Somebody's 65 and they have $2 million inside of a 401k plan that's all pre-tax. And they don't really need the money right now, but we're going to do a Roth conversion strategy, but still their RMDs at 73 are significantly higher than we need them to be due to the tax liability that they're going to take on. Well, we can use a QLAC strategy and shift $200,000 from the pre-tax 401k or IRA into a QLAC, shelter it from RMDs at age 73, and let's just say we set up the contract to kick in income to them at age 80. Now, that income at age 80 is guaranteed lifetime income. They cannot outlive that income. In addition, some contracts you can tack on a return of premium rider. So don't forget about a QLAC contract if you're looking at your RMD calculation and you're scared what kind of tax bracket that it's going to bump you into. Again, in today's episode, I want to cover these quickly with you again. Only 3 in 10 Americans have a plan to minimize their taxes. Here's the top 10 that you should be looking at right now. Take a mix of Roth, traditional, and taxable money. Make strategic charitable contributions. Don't forget to use HSA accounts and 529 accounts when appropriate. Don't forget that you can get tax-free income from life insurance. And also keep in mind that you may want to implement a Roth conversion strategy if your required minimum distributions are looking significantly higher than you'd like them to be at age 73. And remember, at age 70 and a half, you can start to give money to charities from your IRA or 401k in a tax-efficient manner called a qualified charitable distribution. And then also, lastly, do not forget about qualified longevity annuity contracts. So I hope you guys really enjoyed this episode and you found it valuable to you. Use these tools that I just talked you through today to create a tax-advantaged retirement income for you. And if you've enjoyed this episode, I would love it if you would like and subscribe to my channel. And don't forget to share the episode if you found value in it. Thanks for listening today. This podcast is for educational purposes only and may include references to concepts that have legal and or tax implications. It's not to be construed as legal or tax advice. Such information or opinions is subject to change without notice and is not intended to use as an offer or solicitation with respect to the purchase or sale of any security, insurance products, or offer of individual investment advice. Any strategies discussed may not be suitable for everyone. Mutual of Omaha Investor Services, Inc. does not provide legal or tax advice. Please consult with your appropriate professional regarding your personal situation prior to making any financial decisions. Securities and advisory services offered through Mutual of Omaha Investor Services, Inc., member FINRA SIPC. Riser Insurance is not affiliated with Mutual of Omaha Investor Services. Investing involves risk, including the possible loss of principal. Past performance does not guarantee future results. Diversification does not guarantee a profit or protection lost against loss in a declining market. Purchase of life insurance is subject to meeting underwriting requirements. There is no guarantee of an individual will be insured. Annuities are long-term investments designed for retirement purposes. Withdrawals of taxable amounts are subject to income tax, and if taken prior to 59 and a half, a 10% federal penalty tax may apply. Guarantees are backed by the claims paying ability of the issuer and are subject to their terms and conditions.